Welcome to Factful Finance. Did you know that over 90% of professional fund managers underperform the market in the long run? If you want to make your money work for you without the hassle, index funds might be the perfect solution. But what exactly are they? An index fund is a type of investment fund designed to replicate the performance of a specific market index, like the S&P 500. Instead of trying to pick individual stocks or outperform the market, index funds aim to match the overall market's performance. It's essentially a way to invest in a broad range of stocks without having to buy them one by one. Why are index funds so popular? For starters, they offer low fees. Since index funds are passively managed, meaning the fund manager isn't constantly buying and selling stocks, the operational costs are much lower compared to actively managed funds. This can lead to higher returns over time, especially when you factor in compounding. Let's break it down. Imagine you're looking at the S&P 500, which tracks 500 of the largest companies in the US. By investing in an index fund that tracks the S&P 500, you are automatically owning a small portion of all those companies. The value of the index fund will rise and fall based on the collective performance of those 500 companies. This gives you immediate diversification, a key strategy in investing, by spreading your investment across many different sectors and industries. Take Sarah, for example. Sarah's been saving for retirement and decided to put $5,000 in an S&P 500 index fund. Over the next 20 years, the market grows at an average annual rate of 7%. In 20 years, her $5,000 investment would grow to over $19,000. And since she didn't have to worry about picking individual stocks, she could simply let her money compound with minimal effort. If you're wondering about performance, here's a key point. Historically, index funds have consistently outperformed most actively managed funds. A study from Morningstar found that over a 15-year period, nearly 90% of active managers underperform their respective index funds. The reason is simple. Active managers often charge higher fees for their strategies, and those fees eat into returns over time. Now let's talk about risk. Like any investment, index funds carry risks. Market risk, for example. If the market crashes, the value of your index fund will likely drop too. But remember, the broader the index, the less volatile it tends to be. By owning a slice of hundreds of companies, you're less exposed to the risk of any single company failing. So how do you get started? The easiest way is through a brokerage account or retirement account, like an IRA or 401k. You can choose from many different index funds based on what market or sector interests you. Some funds track entire markets, while others might focus on specific industries or regions. Before we wrap up, here's a quick disclaimer. The information shared here is for educational purposes only. Always consult a financial advisor for personalized advice. In closing, index funds are an excellent option for both new and experienced investors. They offer low fees, diversification, and ease of management, making them a powerful tool for building long-term wealth. Whether you're saving for retirement or just getting started with investing, index funds should be a key part of your strategy. Thank you for watching Factful Finance. What's the first investment you'll make this year? Let us know in the comments below. If you enjoyed this video, don't forget to like, subscribe, and click the bell for more insightful finance tips.